Hey everyone, in this video we're going to be taking a look at AP 7B and just kind of going through doing it somewhat partially just to show you guys the highlights, leaving some of it for you to do so you get some extra practice, so on and so forth. So let's get started. So what we have here, we have chart of accounts for June 2018 for this business. And all the normal accounting and transactions during the month have been posted to the general ledger, and we are only responsible for posting the closing entries. And it tells us that the owner invested $5,000 into the business during the month. So the $5,000 is contributions, basically. Keep that in mind. And I think this is kind of apparent. We've talked about this in class or in other problems, or kind of alluded to it, but the contributions go directly to capital, so you don't see a separate account for contributions. You do see a separate account for the withdrawals, but that number of 5,000 is included in this 48,800. So if we take that 5,000 out, you get 43,800. That would be the beginning balance of the month, and then 48,800 is the amount after investing the 5,000. Okay, so step one of this problem is just preparing financial statements here, so the income statement, etc. We've had a lot of practice doing that, so I'm going to leave that for you to do, just basically taking the revenues and expenses off here. I will give you the net income / loss figure is going to be $1,795. So that's just like a check figure for you, but I'll let you fill out the headers and the title of the report, and then the revenues and expenses. So refer back to your materials for lots of examples on that, other videos, etc. We've spent a lot of time doing that already. Okay, but I do want to work through the statement of owner's equity here, because this is a good opportunity for us to look and show month ended. Let me put the titles in real quick. I wanted to show how the statement of owner's equity kind of mirrors the closing entries in a way. And I think that's something we will have talked about in class already, maybe shown separately, but it's a good opportunity here with this problem to kind of dive into that concept and hopefully illustrate it for you guys, so it's a little more clear to everyone what I mean when if I am saying that the statement of owner's equity is essentially the same as the closing entries and kind of that whole process. So without further ado, then we've got all of our line items here. So like I said, again, I'll leave you to do all the nitty gritty preparation on the income statement, but the total should be $1,795 for net income. So we're going to want to put $1,795. Again, that's, prepare income statement first, then take that to the statement of owner's equity. As I just mentioned previously, the contributions or investments into the business was $5,000. And so like I just said, you want to back that $5,000 out of that number it shows there to actually get the beginning a number before that contribution was recorded during the month. And then if we add our two additive items here, the investments and net income, that leaves us with $6,795. So if we add 43,800 plus 67.95, we get $50,595. And then we just take our withdrawals, subtract those withdrawals from the $50,595, leaves us with $49,395. Okay, and that's a completed, statement of owner's equity. I'll give you a couple check figures down here. I'll let you guys do all the heavy lifting in terms of preparing the balance sheet, but I'll give you some check figures just to help out here so you can check yourself when you're done. $80,250 for total assets. Liabilities equals 30,855. And then the capital account is 49,395 when all is said and done. And again, that's just carrying down from there. So this is step 3 because we've already calculated capital, so we can bring that down to get ending capital. And adding the capital and the liabilities and owners adding these two together gets us to 80,250. That matches the total assets. So some check figures for you guys. Like I said, I'll let you fill out all the rest of the balance sheet, give you some practice on that. But let's take a look real quick at preparing the closing entries here. Because I think, again, this is a good opportunity to highlight and to compare kind of the closing entries versus the statement of owner's equity. Okay, so the first thing we always do, right, with our closing entries is to close revenue. Okay, so 3,020. The formatting on these again is kind of wonky. It's centered. This should be over on the left with a little indent for the credit, but it is what it is. So that's our revenue account, and so 3,020. So again, too far. So that'll be our our revenue here. Anyway, let me do one additional thing here, because I think this might be nice for clarity. Oh, oops. Sorry, let me fix that. So when you guys are preparing, the income statement, we've got service revenue of 3,020, and that's just straight off the adjusted income statement here, 3,020. And then I'll at least let you guys put all the expense totals in, but if you add, put all the individual expense accounts in, add up their totals, it comes to 1,225. And, that's the difference between those being the net income. So then when we look at our closing entries here, just to I did that just so we could have a better comparison. So I want you to see how the closing of the revenue, 3020, that matches the revenue there, right? So that journal entry takes that revenue to 0, and it puts it in this temporary holding account called the income summary. Then our next journal entry will be to close all the expense accounts. So we've got advertising expense, we've got depreciation expense, so on and so forth. I'll let you guys fill out all the rest of the expense accounts here. But when you get them all in, the total for these, I'll put in the amounts. You can fill out the account names and all the rest of that, the explanation, etc. But these are all the totals for the expense accounts, all the way down for this journal entry. And the 1,225 is, representative of the total expenses there, right? So, hopefully that kind of makes sense. That's all we're doing is re-inputting the expenses and the revenues, and then closing them, right? So we're crediting those accounts where they initially had a debit at the adjusted after they were, and now crediting them by their amount brings them to 0. So in essence, we kind of moved both the revenue and the expenses together into this income summary. We credited the revenue piece and debited the expense piece. And then the final entry here is to move that amount into capital. And one little trick, or I don't know, it helps me kind of visualize or think about this, is you want the income summary account transactions to balance. So the credit is 3020, the debit is 1225, and so the balance for that is 1795, which is also net income, right? So in essence, kind of what I wanted to show here with this is that we are basically moving net income through this whole sort of elongated process, if you will. It's a kind of a technical process needed behind the scenes of the accounting to get this to actually work, to move that amount, to close the revenue and expenses and basically move the net income into capital or increase capital by the net income. And then if we look back at the statement of owner's equity, you can see that's exactly what we're doing here, right? We have the capital being increased by net income. And so that's what we're doing with our journal entries, is the same thing that we've shown on the statement of owner's equity. So I just wanted to kind of draw that parallel for you guys to be able to maybe understand a little bit better. Hopefully that helps. And then the final closing entry here is to close the withdrawals. And so those were I think it's 1,200. So here withdrawals, 1,200. And we are we're debiting capital. So here we were crediting it to increase it for the net income. Here we're debiting capital to decrease it for the withdrawals. And you can see that that's exactly what we've done here in our report as well. Increase with net income, decrease with the withdrawals. The contributions are already, this cap investments, those are captured in the balance of the capital account. So while we show it separately here, broken out for illustration purposes in our report, we don't have to do any journal entries to effectively move those contributions or investments into capital, because when we made that journal entry to do that process, it went directly into capital. Anyway, so I just wanted to highlight that. I'll let you guys make this pretty and put it in with explanations and finish filling this all out, but I wanted to draw those parallels for you, and hopefully that helps your understanding a little bit. And I'll let you all finish out the post-closing trial balance. You got everything you need to prepare that, above in the adjusted trial balance, and updated capital is $49,395. So that'll be your capital balance. And in your post-close trial balance, remember, there should be no revenues, there's no expenses, there's no withdrawals. Those have all been closed. And so your post-close trial balance will just include all the assets, all the liabilities, which are all just listed here. And then your capital account adjusted for these items here to be now $49,395. And I'll give you just a little check figure, maybe, if this is helpful. So debit balance should be $80,700, and the same, on the credit side, you obviously want your trial balance to match. And good luck finishing that out. Let me know if you have any questions on that. And then, this problem does have some components here of, let's spend a little time talking about the general ledger adjustments. So we want to come down and input our closing entries now, because this is actually an important part as well, is to be able to actually see that when you're posting these, journal entries, for example, these closing entries, in the general ledger, those amounts are being put into the general ledger just like you would for any journal entry. So here we've got two closing entries that affect capital. We've been talking about those. We have an increase for the net income, essentially, the net of the revenues and expenses. We have a decrease for the, sorry, I don't know why that's so small and hard to see, but we have a decrease for the withdrawals. And so this basically gets us to the ending balance that we expect to see is $48,800 plus $1,795 minus $1,200. So this would, adding that in, gets us to $50,595. And again, a good illustration here, because we have the statement of owner's equity here, and you can see $50,009. That is the amount that we've shown in our report, right? And keep in mind, this isn't debits or credits on these reports. This is just like an illustration of the activity, right? And so we're just kind of like, this is for illustrative purposes, but for actually doing the debits and credits of the accounting to get any balances that are included here, we have to kind of go through and do that work. So that's what we're doing here. And you can see when we add the net income in, you get to $50,595, which is that. And then we have a reduction because of the withdrawals. Money being taken out of the business ends up with $49,395. And that's the ending balance that we want in our basically in the post-close trial balance, essentially. And just like you would with anything else, all of these. So you have your 1,200. You debit. You got to have your 1,200 credit as well. So that's just the other side of those entries to reduce withdrawals to zero. The 1,795 will be the summation, essentially, of a few different transactions of I'll do those for you here. So I'll show you. So closing entry, we'll have 3 closing entries, three entries in the income summary account. Again, we want to increase it, or I should say we want to credit it for revenues, we want to debit it for the expenses, and then we want to debit or credit to get it to go to zero based on whatever the outstanding balance is. So our first entry then would be to credit that for the 3,020, and that's that service revenue, adjustment there. So so in service revenue, we're going to debit. So we're at a balance of 33,020, which is what was on our adjusted trial balance as an ending balance. And so we're going to debit that for 3,020, and this is going to go to zero. So again, this is just the effect of those closing entries in the ledger, and then the credit for that, to balance there goes to the income summary. So debit your revenue to get it to go to zero, just like we did that above with the journal entry, and then we credit the income summary for that amount, and then we go through and we for all of our expenses, then we credit each one of those, right? That's the summation of the totals there. So we have to credit each expense account to take it to zero, and then the sum of all those debits is then the sum of all those credits is then debited here in the income summary, right? That's kind of the second part of that whole journal entry process. So that's this 1,225 after doing all the credits here. And then finally, we close out the income summary into capital with a debit there. So that debits equal credits now, so the balance is zero. And then the credit side of the 1,795 is what you see up here that we already input there, basically. So hopefully that kind of helps you get started. I'll let you guys go through and fill out the rest of the closing entry impacts on the ledgers for the expense accounts, let you guys clean all this up. Remember, all we're doing is reflecting all of this activity here with your closing journal entries in the ledger down here. So just that's kind of the key thing, is make sure that all the debits and credits that we had noted above in those journal entries is reflected as well down in the actual accounts, just separated out by which account is being impacted. So hopefully that makes sense. It's a little tricky. The closing entries are always a little bit of a head scratcher, I think, when you first see them. So practice. Let me know if you have any questions, and good luck with the problem. All right. Thanks, everybody.